Welcome to RankiaPro Europe. Today we are speaking with Bruno Vanier, managing partner at Gemway Asset Management and head of fund management. He directly manages the equity funds Gem Equity, Gem Asia, and Gem China. And we will be discussing emerging markets. Hello, Bruno. How are you?
I'm fine. Hello. Good afternoon.
Good afternoon. So maybe let's start with the first question. Many emerging economies such as India, Mexico, or Poland have entered a rate cutting cycle. And historically, this has been supportive for growth equities, for credit markets, and domestic consumption. How do you expect this monetary easing cycle to translate into earnings growth and equity performance over the next few years?
Usually, in any kind of environment, a looser monetary policy is favorable for not only for activity, but also for markets, because also to borrow money from the bank or to invest in the stock markets will be cheaper for any investors, right? So that's the rationale behind that, right? Um, we started this monetary easing cycle last year, right? In some countries, like in Mexico, for example, in India as well. We started in February 2025. And usually this has translated into a better environment for stock investments, right? At this point now, obviously, this easing cycle has already started. Also is already done, right? For some countries. So, like in countries like in Mexico, for example, the potential for more rates cut is limited, although we still expect some rate cuts, but much less than before, right? There's one exception to that, which is Brazil, basically, where actually it was a reversal, right? Last year, we've seen tighter monetary policy as opposed to looser monetary policy that we saw in many other countries, right? We do expect big cuts this year, probably to the region of 200 to 300 basis points. So we should end the year by at around 12.5%. That would be very significant, right? In India, we also expect another maybe cut or two, right? 25 basis plus 25 basis points. That should be positive as well. So overall, I would say that the monetary environment is still positive, but maybe not as positive as last year for many countries.
Okay, thank you so much. And with expectations of weaker US dollar over the next 3 to 5 years, how significant could the currency tailwind be for emerging market assets, especially considering the current undervaluation of several Asian currencies such as the Chinese yuan or India's rupiah?
Once they're starting to see the dollar being weaker, particularly against their own currency, there's a tendency of those investors to repatriate money from US-based assets such as equity or treasury bills into their own local assets, which are denominated in their local currency, right? So this translation or those movements are pushing up the local currency and sometimes pushing down the US dollar. So that's this movement is increasing the liquidity in local markets, in domestic markets in EM. That's typically the case in Korea, in Mexico, in Brazil. When it happens, and by increasing liquidity locally, it pushed down interest rates, and it pushing up equity markets. So that's usually the translation. On top of that, but when we calculate, for example, the earnings of an index, of a group of companies that would be represented into an index, we and if it is in the same country, you just use the same currency, right? But if it's in different countries, you use a common currency, which is most of the case US dollar, right? So the translation of those stream of earnings or in domestic currency into US dollar is favored by a weaker dollar. And so we also see in this case an acceleration in earnings because we calculate earning based in US dollar basically, right? Huh? So weaker dollar will make stronger growth in dollar, right? Huh? And that's taken positively by investors. Same. So another reason for those markets to outperform in this environment, right? Now, the key question is whether the US dollar will be weaker or not. That's a very difficult question, obviously. And not only the dollar, but also the euro, which are two major currencies, right? What we've seen just very recently, of course, with the events in the war in Iran, there's a dollar which has started to be stronger, right? Because people are a bit afraid of this environment, and they usually when you have this kind of uncertain environment, people are going back to what they perceive as being a safer investment, right? Which is the case for the dollar, right? But once this is behind us, we'll go back to this environment of last year, which is basically the U.S. is being the deficit in the U.S. are very big. So many investors think that particularly the investment in treasury bills in U.S. treasury bills is not the best one because interest rates might go up actually. Because of too big fiscal deficit in the U.S. Meanwhile, we can say that the fiscal policy in many EM, many emerging market countries, is much, I would say, much rigorous, right? And the deficit is much less, like countries like Taiwan, Korea. That we not have no deficit, right? So overall, the view of many investors is that not only in the US, but it could be also the case in Europe, actually, that deficits are becoming too big. That total amount of debt is becoming too big. That's why they're a bit afraid of having their assets denominated in US dollar. Hence, repatriation again, and that's what is pushing down the dollar.
Okay, and thank you so much. That's really interesting. And tell me, after years of underweight positioning, international investors appear to be returning to emerging markets, with inflows accelerating significantly in 2025. Do you
26, yeah.
see this? Yeah, do you see this as a beginning of a sustained relocation toward EM equities? And if so, which regions or sectors are likely to benefit the most
Mm.
from these renewed flows?
Well, it is a case that international investors have been pulling money out of emerging markets 3 years ago, even 2 years ago, right? Last year they came back slightly with around $30 billion, right? Which is quite small actually compared to what the outflows of the former years, or of the year before, 2022, 23, right? Well, the point is that emerging markets have outperformed last year, right? So as a global investor, where the benchmark is maybe 100% equity. I mean, I'm not talking about the people who are focusing on equity, right? Um, if they were to be neutral in emerging market, they would have 11%, right? That's a neutral position of emerging market relative to the rest of the world, right? It turns out that last year the average position for global investors in EM was more like 5.1, 5.2%, right? So roughly half of a neutral position, which means that basically global investors have been very underweight EM for a number of reasons, of course, and they've been quite right actually, because EM have underperformed quite a lot over the last 15 years, right? It's over the last 5 years. It's only that last year that EM have started to outperform, right? So overall, based on past performance, global investors have been have chosen rightfully actually that to be out of emerging markets or to be very underweight the EM, right? Now they realize that well, maybe it's time to change their mind because the market is starting to reverse, right? And particular from the US one. Actually, the US market has been a very good market over so many years, right? But last year it has started to underperform. So, so basically, global investors have decided to take a asset allocation decision, right? Or at least they want to reverse a position, a very big or underweight, so big underweight position they had in their own portfolios, and now they're coming back, but they're still quite low in terms of positioning, right? They went from 5.1, 5.2% to now more like 5.6, 5.7%, right? So it's still very underweight. Now, whether they will go to back to 11%, it may take a bit more time.
Okay, and at the same time, there are political tensions, particularly the evolving conflict in Iran and the potential risks around the Strait of Hormuz. So, could disrupt energy markets and global trade? Do you think that it could be disrupt? And how do you assess these risks for emerging economies? Many
It's
of which are sensitive to commodity prices and trade
exactly. I mean,
dynamics.
yeah, usually, well, the whole of Asia, with maybe one or two exceptions, but most countries in Asia are net buyers of oil. Obviously, they're buying a lot of oil from the Middle East.
Hmm.
China is also buying a lot of oil from Russia, right? India is also buying oil from Russia. So net all of Asia is a net importer of oil, you see, and a big portion of that is imported from the Middle East. So obviously, the fact that the Strait of Hormuz is de facto closed, they, there's going to be they might have two issues. Well, the first issue is that the price of oil is going up, of course. So the price of energy is going up a lot. So that's a negative for every importer, of course. And second is even though and even the price is high, but the availability of oil could be under questions, of course, because as you know, no ships can go through the Hormuz Strait, right? So um, those countries have strategic reserve, like China has been buying a lot of oil the last couple of years, more than what they use, but it's still not a very big amount. So they can sustain a couple of months, of course, of disrupted supply. But the more you wait, the more the problem can be significant, right? The more we wait, the more the war is lasting. Obviously, the more serious it becomes, right? On the other hand, you have other countries which are producing oil, right? In Brazil, we do produce oil. We are not exporter of oil, so it's a positive for them in a way. So some countries are making are in a favorable situation, but generally speaking, most EM are importing oil, so they are in a difficult situation right now. But as I said, it could be only exceptional. Right?
Okay, and the last question that we have for you. So, given this combination of supportive macroeconomic factors like strong GDP in Asia, ex Japan, still compressed valuations and improving earnings prospects, alongside geopolitical uncertainties, where do you currently see the most compelling opportunities for investors in emerging markets?
Overall, in the longer term, providing this war is going to be ended at pretty soon, all the various themes are still very valid. And the first one is technology, right? In Korea, in Taiwan, you have the largest companies producing memory, right? And and we need a lot of memory. I think this is a very strong theme, and we quite like it. We have a roughly 31% of the portfolio, Gem Equity, invested in Korea and in Taiwan. Now you have ideas, other themes. India is one of them. India has been an underperformer for a number of reasons. We're starting to see reversal of this underperformance, right? Further, the rupee is very cheap in terms of the currency, and the monetary policy has been looser right now recently. So it's very conducive for growth. And I would say in consumer, in banks, you have very good opportunities at a reasonable price, I would say. So India is quite interesting. Another big story in Asia is obviously China. China is more complicated, I would say, because this is not a country anymore where you have strong growth, right? The Chinese growth of 10%, 15% is over, right? We don't have this anymore. But it's not necessarily bad news, right? When the growth is not as strong, it means also that competition is which has been very strong, is getting better now. So and you have local companies, particularly in industrial sectors, that are taking market share from international companies, particularly German companies. Right? So in automation, in even in robotization, you have sectors which have pretty good growth, but also the market share gained by local companies that you can buy in the stock market. So I would say from a stock picking point of view, China is very interesting at this point. Huh? Now you can tell me that Chinese growth or Chinese retail sales consumption is not very strong, and that's true, right? We don't expect very strong numbers on that side. But as I said, we don't need that actually to find good ideas. And also the valuation, generally speaking, in China is quite low. So your risk is limited because of that. Huh? So that's another story, right? So we have at least three stories in Asia, right? Huh? Now going to the other side of the world in Latin America, the biggest story is obviously the interest rate or interest rate cuts that we're going to have in Brazil, right? Huh? Now this story might not be as quick as tomorrow because we're going to have election in Brazil in early October, and during election time there's a volatility, so the central bank maybe don't want to be seen as being aggressive, so maybe the interest rate cuts will be pretty small before the election, but then after that it will be bigger. So I think that Brazil could be very good, very good investment theme starting fourth quarter this year. So you can always start it now.
Okay, thank you so much, Bruno. And thank you to everyone watching us. Don't forget to subscribe. Thank you so much.
Thank you.